Hello traders and aspiring traders. Welcome to the first video in our educational series. My name is Erika and I'll be your guide throughout this exciting journey into the world of trading. In today's session, we'll be diving into several key concepts that are crucial for your trading success. We'll start by discussing the differences between bull and bear markets, terms you'll hear often in the trading world. From there, we'll move on to leverage, what it is, and how you can use it to amplify your trading potential. But that's not all. We'll also explore why the Forex market operates 24 hours a day, and most importantly, how you can profit in this constantly moving market, whether it's going up or down. By the end of this video, you'll have a solid understanding of these fundamental concepts and how to use them to your advantage in your trading strategy. Let's get started. From a technical standpoint, there are two trends that every trade should be aware of: an uptrend and a downtrend. In trading, buyers are called bulls and sellers are called bears. Therefore, when the market is going in an uptrend, we say that we are in a bull market, while when the market is falling, we call it a bear market. As already mentioned, one of the main benefits of short-term trading compared to long-term investing is the fact that it gives you a chance to make profits even when the market is falling. We could do that by selling an instrument, which we don't need to own in the first place, and then buy it back when the market goes down. This is something that isn't possible to do when investing for the long term. Thus, most traders prefer to use the short-term trading approach because it gives them a chance to make money in both directions of the market, on the way up and on the way down. I can give you a recent example: the pandemic situation around the globe. When the pandemic started, that led to a massive economic slowdown around the world. Lots of businesses went bankrupt or lost a majority of their market share, which led to lots of people losing their jobs, and of course the inevitable economic slowdown we are discussing. Following those fundamental factors, the stock market, for example, took a big hit. We saw a massive correction in the next few months. If you were a long-term investor and just bought some shares and wanted to use the long-term buy and hold strategy, you would have been on the losing side for a long time after the pandemic started. Yet, if you were a client of 24yield, you would have been able to short sell the market and make money when the market was falling. And then after the massive correction, you would have been able to buy your favorite stocks at a big discount and be able to make profits to the upside as well. Besides the short selling option we mentioned on the previous slide that gives us a chance to make money even when the market is falling, there is another main benefit of trading compared to long-term investing. It is called financial leverage. In fact, leverage in trading enables us to open a position worth much more than the money we invest in our trading account. For example, we could multiply our position size by 5, 10, 20, or 33 times the amount of our initial investment. Practically, when we do short-term trading, we don't physically own those assets outright. We only trade with the difference in price in order to make a profit. When we use leverage, most of the capital is put up by the broker, and we only put down a deposit that is worth a fraction of the trade size in order to open a bigger position. In other words, you are putting down a small fraction of the full value of the trade you would like to open, and your broker is lending you the rest. Even though you are only paying a small percentage of the full value of the trade up front, your total profit or loss is calculated on the full position size and not on your margin amount that you have invested out of your account balance into that position. For example, we could open a trade on Amazon stock worth $1,000 with a deposit of only $200. 24yield as a broker would put up the other $800 initially, giving you a chance to open a position 5 times greater than your initial investment in that position. Overall, financial leverage allows us to benefit from different movements on the market by only investing a small percentage of the total value of the trade. Yet the profit we make at the end is the same. It is calculated by taking into account the number of shares or units, if it is a different instrument, we are buying or selling multiplied by the difference in price based on the movement on the instrument we are trading with. In case of the example of Amazon, if we buy 10 shares at $100 per share, the required margin for opening that position on the account would be only $200 thanks to the leverage, while if we open that position on the physical market where we buy and hold shares for a long term, then we would have to invest the full amount. 10 shares times $100 equals $1,000. In other words, on the 24yield platform, our clients only need to invest $200 in order to open that position, which is 5 times less than the investment they would need to make on the physical market. Yet, the profit is the same. If Amazon's share price goes up from our initial buying price at $100 to $110 per share, we will still make the same profit we would have generated on the physical market, which is $100. Our traders use leverage for all financial instruments we have available on the platform, and the leverage is different on other instruments such as Forex, commodities, indices, and cryptocurrencies. Please be aware that the effect of leverage magnifies your potential profits, but it also magnifies your potential losses if the price of the instrument you are trading moves against you. Another benefit of trading on the Forex market is also the fact that it is open 24/5. The reason for that is because currencies, commodities, and indices are traded on different markets. In other words, we have a few sessions during the day, such as the Sydney session, the Asian session, the European session, and the US session. That gives a benefit to traders because they could trade those instruments anytime during the day and night. The only instruments that are traded over the weekend are cryptocurrencies. They trade 24/7, and traders could trade those instruments even during the weekend when the rest of the market is closed. Let's now jump into some specific examples of how we can make a profit on the Forex market. We firstly analyze all potential fundamental and technical factors that might have an impact on the specific instrument we are about to trade in order to come up with some expectations as to where the price would go next. For example, imagine we have analyzed the recent performance of the euro versus the US dollar, which is the most traded currency pair out there. And we have reached a conclusion that based on some economic reports or events, as well as by analyzing the chart, we believe the euro should appreciate or go up against the US dollar. Then, the first way for making a profit is by opening a buy position at 1.06, for example. When the price increases in value, we would be making a profit on the way up. As the price increases, we still need to follow different factors that have an impact on the instrument we have opened a position on, and that would give us a signal whether to keep the position longer or simply close it and take the profit. Once we see the price has reached the target we have set for that position, we can close the position at 1.08, for example, and make a profit on the difference in price. If we believe the price has reached its peak for the current moment and it would go down, we could open a sell position, also called short selling, at 1.08 and then take our profit by buying it back at 1.06, for example. The profit on both movements is absolutely the same. In the next example, we decide to buy the Euro USD at 1.06 by opening a position with 10,000 units. That would use a margin of $333, which is the amount of money that we need to have on the account in order to open that position. When the price goes up and we sell it at 1.08, we make a profit of $200. It works the same way to the downside. We sell 10,000 units at 1.08 and close the position and buy it back when it goes to 1.06 and make the same profit of $200. And that wraps up today's session. I hope you now have a clearer understanding of bull and bear markets, how to use leverage to your advantage, why the Forex market operates 24 hours a day, and how you can profit from these opportunities. Remember, trading is all about knowledge and strategy, and you're already on the right path by building a strong foundation. If you enjoyed this content and want to dive deeper into our educational series, head over to our official website. The next part of our series will be focusing on the different chart types, so feel free to visit us at 24yield.com to continue learning and take your trading skills to the next level. I'll see you in the next video.